Draining and adding liquidity to the boring old money markets traditionally allows central bankers to influence a string of interest rates across the maturity spectrum. Historically, the role of the central bank has been to send strong messages to the rest of the economy by starving or flooding the shorter end of the market in order to signal exactly where it wants the yield curve to be. Most college graduates who were in the workplace when the Federal Reserve last raised its benchmark interest rate in 2006 will not have felt the impact of monetary tools, yet are now in their 30s and are possibly mortgagees and very likely have an auto loan and credit cards. Given Wall Street's cautious approach to what may constitute a normal Fed funds rate of interest, this segment of society is likely numb to the impact of changes in monetary policy because they just don't know how it feels. The May non-farm payroll report is expected to show job creation of 162,000 positions according to the median Thomson Reuters estimate, although the net number is likely to be confused by the impact of 35,100 Verizon workers on strike since April who are technically counted among the unemployed. However, it is likely that some of the current weakness in the labour market represents fallout from fears expressed for global growth during the first quarter of the year as stock markets corrected. Should the Fed lift interest rates in June, it might be jumping the gun on a return to health for the labour market, where the most granular initial claims measure has so far this year put in a weaker showing. For monetary policy, the problem is that, as an economy, many people are out of tune with living through a rate-rising cycle, and we can't pretend we know how they will act. The problem is not that monetary policy no longer works in the manner in which it was intended. It very probably does. The problem is that, after a decade of being on the floor, people have forgotten the purpose of monetary policy. It is assumed that the Fed can get back to normal and reinstate the simple 2+2 formula of imposing 2% rates on top of 2% inflation. However, what we should not forget is how economic activity slows down as policy tightens. It always has done in the past. And while it is not the Fed's job to manufacture inflationary pressures, they are a necessary input to the successful use of monetary policy as an effective tool. Outside of the oil patch, there are scant signs of rising prices requiring the Fed to reinstate higher rates. With non-farm payrolls resting under 200,000 per month, the actual mechanism of increasing borrowing costs by a string of quarter-point increments is unlikely to spark higher readings. Instead, it might just lead to lower payroll readings in the future. For more market commentary, join us at IB Traders Insight at ibkr.com/TI.